morning, and today we are going to cover chapter 14 and 16, which is related to each other. So today we will start talk about the practical things, the core work for the auditors. When the auditors go to the company, they categorize their work, as we said, into a segment accounting cycles, and based on that, they will implement what we has mentioned in the previous chapters in terms of testing internal control, running the substantive test of transaction and event, running the substantive test of details of balance, do analytical procedures. So now what we will discuss today is to show how we do it in the reflecting those practice and process into the accounting cycle. So today's subject or today topic is about auditing the revenue and cash receipt cycle. So we know what is revenue. Revenue is a money in, money flow to into the company, either by operation, by selling goods, or by selling services. Okay, so this cash in or money in, we should recognize it and record the transaction. So what we will do now, first we will identify the functions, the main functions in the related to the revenue cycle, and we will also identify the main documents, the main internal control system related to the revenue cycles. And then after that, we will discuss how the auditor what is the auditor objectives in this revenue cycle. Then we will discuss about what audit process or audit procedures that the auditor should follow to matching that audit objectives and the functions of the revenue cycle. Okay, so what is revenue? Revenue is money come in as a result or outcome of the operation of the company. When it's recognized, when to recognize this this revenue? Should we recognize it when we earn it, or when the cash in, or when we send the goods to, or ship the goods, or deliver the goods to the customer? So that is also a question. When is the point of sale? Because also we have 2 points of sale. We have FOB destination and FOB warehouse. It means the company itself warehouse. So should we recognize in when we deliver, when we send the goods, when the goods go out from the company, or when the goods received by the customer? So it depends, because we have 2 types of FOB. According to the agreement with the customers, we will recognize the income. So how is it recognized? So revenue recognition principles is one of the accounting principles that we study. I believe everyone is aware about it, but just to for refreshing this information, most of the companies or most of the countries following the accrual recognition, or the accrual principle. Accrual principles means we have 2 accounting base for recognition. One is cash principle, and the second one is the accrual principle. Accrual principle saying that we can recognize the revenue even before we collect the cash. Reason? Because we already send the goods to the customers. But when should we recognize? Is it in the time of selling, or the time we the customer send the customer order, or the time we ship the goods, or the time we the goods received to the customers. All of that we will discuss it in short while, but this is the main difference between cash and accrual base of recognition. Just to remind you, the overall revenue and receipt cycle. This is the basic transaction what we do. We in T account we have, when we have transaction or when we have cash transaction, we will have direct recording, and we will credit the cash sales in the sales, and under the bank or the cash account we will debit. Okay, so but if we sell on credit, then we will credit sales in sales account to record the transaction, and then we will have account receivable account to mediate and record the liability that we, or the current assets for us, or the liability for the customers. So we will credit sales, we'll record it in debit side of account receivable, and then when we collect the cash, we will credit the collection, and in the side of bank we will debit the collection or the account receivable. And then we have another recording in case of if we give discount, cash discount, or when we have sales return, and when we have bad debt. All of this will affect the credit side of the account receivable. Okay, so this is more details, but it carries the same concept. Okay, so what departments involved in the revenue cycle and cash receipt? We have the sales department, credit department, shipment department, billing department, and accounting account receivable department. And also if we have separate cash collection department, if there is, so we will have that. Otherwise we will receive receiving the check or transfer through the bank, and they will inform through documents. So first we will sales department will receive the customer order, and then they will try to check the credit limit for this customer, and then they will update the sales department. If the sales department okay with the sales, with the credit limit or credit status of the customer, then they will send to the shipment to prepare the shipment, to double check the shipment, and then when they send the shipment, they will do the billing. They will prepare the invoice and send one copy to the customer and one copy to the account receivable department. In the account receivable department, they will start to record the transaction. Okay, record it in the in general ledger and in the journal also. Okay, and also they will send one copy to the sales department. And we should recognize that we need to segregate some departments from each other. If we are a small company, then we need to segregate the duties itself. So the one who issue the bill or the invoice shouldn't be the one who record in the account receivable department or account receivable function. Okay. So now let's say what is the main functions or the general functions and activities under the revenue and cash collection receipt. First, we receiving orders. Second is credit check and approval. 3, delivery of the goods. 4, if any returns. If there is a return of sales, then we have this function. And then payment received. We receive the payment from the customer. Number 6 is recording of transaction. Okay, so this is the document that we will it will involve with us. Let's actually we will separate and discuss this in details in a short while. Just this slide, it show only the summary. Let's see the flow chart. So just to see the flow of the transaction. So the first customer will send the customer order. Then what we will do, we will process receiving the order. And what we will do in receiving, when we receive the order, we will try to check the credit sales order, try to check a copy of the sales order to check the credit. So how to check the credit? Checking the credit, we will check the credit record file. So normally, if it is manual, then we will have file for the previous transaction and payment of the specific customer, and we check whether according to the SOB of the company, what is the credit limit. Let's say it's 10,000 ringgit. And this customer order is due to us, due to the company with 5,000. So he need to top up or pay cash for some amount in order to process this customer order or this order. So after that, they will return back the approval of sales order. If there is no approval, then they will send back to the customers the information of rejection or the notice what they supposed to do, what the auditors should do. Okay, so then they will receive the date and approval date. They will keep it in one file. Normally, if it is computerized system, then it will be default information to be summarized. Then we will send the approved received order to back goods or shipment of goods. So they will check the product quantity. They will check the availability of the quantity through checking the system and checking the existing of the physical goods and product. Then after they do that, they will verify the stock release by sending the ships goods, and they will check with the receiving orders, double check with the goods that it's prepared to send. So in that time, they will send backing the stuff or delivering the stuff to the customer, and also they will send along with the bill of lading documents to the customer, just to show the details of the shipment and delivery company or method. Then we will keep this information about the time they send the stuff into the open order file. So, and then after we send the goods, we start to send shipping notice to the bill of customer. Process means we are preparing the invoice, and when we prepare the invoice, we send a copy to the customers, and we also put it in banding file for invoice one copy, but this one is updated when we update the journal. And in this time, after we bill the customer, we start to record the transaction in the accounting cell journal. If you notice, this is the starting point or the point that we start to record the transaction. So what is expected of document here when we record in cell journal, that we should have invoice, and we should have receiving customer order, and we have sales order approved by check credit, and the shipment documents that specify sending the goods to the customer. In that, so if the sales is on credit, so we will update also the account receivable and update the inventory record. We update the inventory record because we need to reduce the inventory according to the quantity of the shipment of the goods. Then update the subsidiary ledger of inventory and account receivable, and then update the sales journal voucher in the and we post all of this in a summary to the general ledger. Finally, we update the general ledger of record and general voucher of files. This is quite details, but what we try to understand here, we try to see the documents flow, the activities flow and the documents flow, and we can see that there is, in some point, there is a control function should be taking place, like having we should record in sales journal based on several documents, and it should be there. We should have check credit, we should have shipment goods record, and so on. Okay, so let's say we break it down and see the details of each one of the functions. So processing the customer order, we need to differentiate between customer order and sales order. Customer order is the request of the goods or services by the customer themselves, or himself or herself, whereby the sales order is internal documents that we prepare describing the goods ordered by the customer. So because sometimes the customer will just bring some like the name, the full name of the product that we have, but in our system we have coding. We have coding for this goods. So let's say product number 1/35. So this is the code of the goods. So we need to first put this specification to check in the system, one thing, and also we use the internal sales order to as one of the internal control tools to verify, not to rely on the customer orders, because sometimes the customer order, let's say the quantity of 10 items or 10,000 units, but after double check the availability, we just prepare for what we have, which is 5 or 7 items. So not necessary the customer order is same like sales order. Okay, so then we need to guaranteeing the credit before goods are shipped. A properly authorized person must approve credit to the customers for sales on account. So we need to check the credit history. How we do that? Normally, we should the company should establish what we call standards and categorize the customers, especially the long-term customers that we have, into categories. Let's say if you see in the page, we have category A, B, and C. So, and based on each category, we give different amount of credit limit and different time of payment. So let's say the golden or A customers category, or golden, sometimes they call them the golden customers. Those customers, they are like big customers, and their credit history is very excellent, and so we consider them in terms of their payment for the last time. So we will give them, let's say, and also based on the documents that they provide, like bank statement, and also based on other stuff like company size. The example, if you are doing business with like Petronas or Sim Darby, those companies are very well known. famous, they are big. So you will immediately give them high rank of category of credit limit. So you'll give them 3 months and you'll give them up to 1 million of transaction. But let's say you get a small shop, they come to buy from you the grocery or something. So they will, the story will be different, and you will be preferred to have less amount of credit to that customer, and also shorter period of allowance or tolerance to collect the money from them. So that's what we call risk management or credit risk management. We need to manage that, and this one should be based on certain categories or certain factors that affect the size of the company, the type of business, as well as also the history of credit of the customer, credit age, and so on. Okay, so then we have the shipping goods. This is the first point in the cycle where the company assets are giving up or transfer. So in this time, we transfer the goods to the customers, and normally this is the starting point or the right time to start recording the transaction into the journal, sales journal, and so on. Okay, so let's say let's move to billing customers and recording sales. So in here we have sales invoice. We need to prepare sales invoice or billing. We need to start to update the sales transaction file with this invoice. We need to record in sales journal or listing. Sometimes we have listing first. We list down small invoice transaction, and then we record it one shot. Then we update account receivable master file if it is credit transaction. Then we prepare or update the account receivable trial balance, and then we send monthly statement to the customers. Please notice this list of transactions usually when you are using accounting software, by issuing the sales invoice, the rest of functions is automated functions. It will record in the sales transaction file, sales journal, and account receivable master file. All of this will be updated, and if you request monthly statement, it will be generated with a click. Okay, but you need to understand what is the function that will be happening in the recording of the sales transaction. Okay, so here we have the tables explaining 3 things under sales transaction: the account, the business function, and the related documents and record. So in sales account receivable, when we sell on credit, so we will have first we will need to process the customer orders. So in this case, the documents related to processing customer order is customer order, and normally now it is through, sometimes it's through the system or through the website. Some of the companies still receive customer order through the phone, and then you record. We have the sales order, which is the internal document that we mentioned just now, and then we need to generate credit. And when guaranteeing credit, when to do guaranteeing the credit process, normally we sign and approve either through the system by click approve, or through stamping on the sales order, approve and sign by authorized person. Then we have the shipment of goods, and in the shipment of goods, we should have the shipping documents. In some countries they call it billing and leading documents. Then we have the function of billing the customers and the documents related to the billing customers process is sales invoice, preparing the sales invoice, and sales invoice either to be computer based or printed invoice or invoice that written on hand. But we have certain internal control related to the those documents. We will discuss it in a short while. Then you see after we issue the sales invoice, so we start the process of recording the sales. In the yellow side, you see sales transaction file, sales journal or listing, accounting receivable master file, updating account receivable trial balance, and monthly statement. All of this is consequence of the sales invoice. I hope you get the flow of this sales transaction. Okay, let's say if we receive the cash. So if we receive the cash, three main functions: make the cash sell, mean receiving the cash, and we need to record the cash received transaction, and then we need to create the sales entry in the account. Okay, so what is the process? First, we do, if we receive cash from the customer that we usually involve in several transactions a month, and they will pay us or pay to the company for not only one single invoice, for several invoices. So we will have what we call remittance advice. Remittance advice is listing the invoices that it's settled in this remittance advice, and they will show the amount that they are settling, the company, the customer settle, and also they will show the due amount after settle or the balance due. So, and then we have pre-listing of cash receipt, and we have cash receipt transactions file, cash receipt journal, or listing. So processing the record of cash receipt is as simple as this. We receive the cash, we do pre-listing of cash receipt, and then we record the cash receipt in the transaction file. So as I mentioned just now, it's summarized and put it in table, cash receipt transaction. So we have processing and recording the cash receipt, remittance advice. We have pre-listing of cash receipt transaction file, and cash receipt journal or listing. So we have, if you notice, the first one, remittance advice, is the main documents received by the customers along with the check or the transfer to the bank, and then the rest is kind of recording, updating the transaction file, updating the cash receipt journal. Okay, so now we move to the processing, the recording of sales returns and allowance. In case there is a allowance, we give them allowance due to defect items or due to past payment of the due amount, or due to, as I said, defect items that we send them, then instead of return this item, we give them allowance. Or sometime they return the items because it's not either it's not fitting them or it's not according to their sales customer or customer's order. So in that case, we will have processing. We need to process and record the sales return and allowance. What we need to have credit memo. And credit memo, normally it should include the specifications of the goods returned and the invoice they are related to. So let's say it is from the invoice number 135. So it should mentioned in the credit memo, and they should mention also the reason for returning and the settlement. In that case, so we need to create record in sales and returns and allowance journal. So we need to update the sales and return and allowance journal. Okay. So in case we normally the company, especially the company who you keep selling on credit, and they will face normally they will face what we call writing off uncollectible account receivable. Through the year, some customers will not pay, or sometimes they will disappear, or sometimes they will announce bankruptcy. They will keep hiding or closing their phone. We cannot follow up with them. So normally we cannot keep their liabilities in our account as account receivable for long. So we need to what we call write off. We need to write off the account receivable by that amount that we feel it take long time, no one pay us back. So uncollectible account should be by authorized people, and normally authorized form, and this form or authorization should be normally in top level, or sometimes they will have 2 layers according to the amount. So in big amount, the board of directors or CEO should approve and authorize that writing off, because we are recording lost. We are demolishing something. We in the financial statement or in the balance sheet and the current account or current assets, we show that we have account receivable of 100,000, and if we write off, we are reducing our assets. So it is not an easy decision. So it should be in the top management level, or the sometimes if for small amount, it should be approved by CFO, the financial controller, chief of financial control. Okay, so this is a document used internally to indicate authority to write an account receivable off as uncollectible. So we need to reduce. If we are planning to reduce, so it should have proper documentations, authorized form or report suggestion by the, let's say, by the financial manager to the board of directors. So when they approve, then we can when they approve, we can write off that amount. So what is the process of writing off uncollectible account receivable? We need to have a proper authorization form, and then based on that, we will update the general journal. Okay. For this situation, for this kind of activities, like what we say, the bad debts. So when we write off, so we need to have provision. We need to have provision to help the company to face this kind of situation of allowance for uncollectible account. So we should providing help or provision, having preservation for what we call uncollectible account. So this provision represents a residual resulting from management end of period adjustment of the allowance for uncollectible account. So what we will have here, we will providing what we call providing provision for the bad debt, and it will affect the documents related to that will be the general general journal. Okay, to this step, we already finished the functions, the documents related to the account receivable, related to the sales and revenue functions. We discuss also the main documents. We discuss the flow of the transactions. So by now, we need to reflect the auditors. What auditors should do now? So auditor start from this point of time. So there is a methodology for designing controls and substantive tests, and this point has been discussed in chapter 13. You can refer to chapter 13, and also it's explained in details in the chapter, in the book. Okay, so the first point is to understand the internal control cells. So we need to understand the internal control cells. And then number two, we need to assess the planned control risk for cells. Number three, we need to determine the extent of test of control. And then we move to testing or designing the test of control and substantive tests of transaction for cells to meet the transaction-related audit objectives. And it will not, when we design the test of control and substantive tests of transaction, we should bear in mind 4 items to be included: type of audit procedures, the sample size, items to select, and the timing of the test. And I put this arrow here just to show sometime when we do the assessing of control risk, we have the decision, as I mentioned in previous chapters. If we are not planning to extend the testing of control, so we will go direct to design. And this happen normally with the company that their internal control, either when we assess the internal control risk, so we found that this result will not be changed if we do further test. So let's say company that they don't have proper internal control. So no need to waste your time as an auditor to take another sample to check the internal control and so on, because they don't have, they have only one staff to run the accounts. So it is no meaning to waste the time and do to extend the test of control, because the result will be same. So instead of extending the test of control, just go direct to design test of control and substantive test of transaction. And normally we will have more tests of transaction. Okay, now let's say we need the first step here is the understanding the internal control cells. As we explained earlier, we need to study the client flow chart and and to prepare the internal control questionnaire and perform walkthroughs through test of cells. So what we will do, we will first see the flow chart of the transaction, of sales transaction, as if they have, just now I show you the flow chart of the sales transaction. So we see what they have. Normally they will have the flow chart. If small and medium companies, we didn't expect them to have, but if they have, then it will tell us more information. And then if not, then we need to prepare a questionnaire to ask questions about the internal control. And then the second point or the second process to understand the internal control is to walk through test. Walk through means we try to see how they process transaction, and we view it step by step. Okay, so Assessing plan control risk. Number 2 is have 4 steps. We need to set up the framework for assessing control risk. Number 2, identify key internal control and deficiencies. Number 3, associate internal or associate controls and deficiencies with objectives. And when we say objectives, here is the auditor's objectives related to that phase. And lastly, assess control risk for each objectives. So what is the internal control activities related to the cells when we are trying to assess planned control risk? First, adequate separation of duties, proper authorization, adequate documents and records, pre-numbered documents, monthly statement, internal verification procedures. And if you remember, in I think in chapter 10, we have discussed the 3 categories of internal control. We have preventive, deductive, and corrective. Preventive means it comes first, trying to prevent the risk from happening. So normally the functions under the preventive is the approval process or activities, authorization, verification, segregation of duties. Whereby deductive procedures, deductive internal control activities is reconciling, review, data analysis, based budgeting and actual, benchmark, computer assess audit techniques, and we can call this all is under the internal audit or independent review. And then we have corrective. Corrective activities is system resolution, control changes or addition, adding control activities, data validity test, insurance, variance, report, training the staff, and increase the awareness, just to ensure that they have it. They have the right, the corrective, normally the corrective functions is to ensure that this risk will not happen again, okay? So according to ISA 315, auditor should obtain an understanding of the entities and its environment, including its internal control. So part of the auditor objectives, according to ISA 315, to understand the entity and environment of the client. Also, they need to understand the internal control. So the procedures and its objectives can be done through the questionnaire. We try to apply the questionnaire to check the accuracy, the occurrence, the completeness, the accuracy, cutoff, and classification. So this is an example of what the question is, what questions we will include. So I'm asking now each one student to let's say I will one student read one question, then I will explain. So who will be the first? Hello?
Me, sir.
Yes, please read the first question.
First one, a customer orders review for terms such as prices and quantities.
So this question is, we are trying to say whether the company is trying to check and verify the customer order in terms of the price and quantities. So we need to see whether they have controlling the customer order, not just receiving and send it direct to the warehouse for shipment. Okay. Number 2.
Yes, sir.
Yes, please.
Pre-number sales order use.
Okay, so remember, sales order is different from customer order. Sales order is internal. So if we are using pre-numbered, if the company using pre-numbered means they have good internal control. Why it's good? Because the auditor, when they come to check, because it's internal, let's say there is a missing sales order, missing numbers. So the auditor will ask why this sales order number 156 is not available. So normally, if they use pre-number, they will keep it in one file for the auditing purpose. Okay, so it's kind of controlling the sales department. We control the staff from playing around with the quantity and price of the sales order. Okay, number 3.
Yes, sir. All
Yes,
credit
please.
sales all credit sales approved by the credit department before shipping.
Okay, so now what we are trying to ask in this question, we are trying to ask the existing of credit sales approval. Okay, so whether they do it or not. If they say yes, then we will go to the second question. If they say no, then we consider it as deficiencies of internal control. Okay, number 4. Question number 4, please.
Is the credit department independent of the sales department?
So now we are trying to test the segregation of duties between the sales department and the credit department, because normally the front desk who deal with customers is the sales department. So they receive the sales order or the customer orders, then they prepare the sales order. Supposedly they are not the one who approve. Suppose is the accounting department, or if big company, they will have separate department called credit department. Okay, so we are question number 4 are examining the existing of segregation internal control activity. Number 5.
Is there an approved customer list with credit rating and limits for approving credit?
Okay, number 5. Question number 5, we are trying to check whether the process of credit limit, whether they have a customer list and credit rating for customers. If they have it, then okay. And normally question number 5 and 4 will not be asked if question number 3 is if the answer of question number 3 is no. If they don't have credit limit, credit approval process, then we will not ask question number 4 and question number 5. But if they have, then we will try to check the effectiveness of the internal control of credit limit approval through the process, whether they have customer list, approved customer list with credit rating and limits. So supposedly each customer, they have rating and also limit of amount they are able to buy on credit within this amount, not exceeding it. Okay, number 6.
Shipment check against sales invoice for quantities, model, etc.
Okay, number 6. After they approve the credit limit and so on, they send the customer order. They send the sales order approved by the credit department to the shipment department. So shipment department, or we call it the warehouse, they start to prepare the goods. So based on what they will prepare the goods, they supposed to prepare it based on the invoice and based on the sales order. and customer order. Supposedly they have those three documents, and if it is computerized system, then it will be based on the invoice draft. So what they check, they need to check the quantities, the specifications of the items. So if they do so, then that's good. Number 6 is trying to check that they are trying to control the risk of sales return. Because if they didn't check the quantity and models and specifications of items, then we will the most probably the inventory staff will send wrong item, and wrong item means high cost of return, and also we have sales return from the customers. Okay, number 7.
Pre-numbered bills of lading late.
Okay, in this question, we are trying to check the control by in the documents. So we are trying to check whether the documents of shipment documents are pre-numbered. Billing bills of lading. Normally we call it, also we can call it the shipment document. So are pre-numbered. If they are pre-numbered, then it is good. It is more reliable document. Okay, so we are checking here the document verification. Number 8.
Are unused bills of lading safeguard and check periodically?
Okay, so now here we are trying to, in this case, we are trying to see whether the company having checking or review process for unused bills of leading safeguarded and check periodically. Means we, because we have, as I said, it's pre-numbered. If they have pre-numbered bills of leading documents, so we check those unused documents of shipment. Did they check it periodically? Let's say monthly, weekly, every quarter, every 3 months. So they check it. If they check, then we say that they have what we call deductive internal control process, which is review, independent review. And normally the one who will do this is the internal auditor, if they have this department. Number 9.
Is the numerical sequence checked for missing periodically?
So this one is also deductive control. We check the existing of the review, independent review, based on the numerical sequence. Mean we are checking the pre-number of the bills of lading. Why we are focusing in bills of leading documents or shipment documents? Because remember, inventory is the assets of the company. So if it is not controlled well through the document, through the review, and so on, so we expect misappropriate of assets, which is thieftness or stealing the assets by the staff or by the management if they try to overestimate or underestimate the financial statement. Okay, number 10.
Sales invoice form and credit memos pre-number.
Okay, so number 10, now we are talking about the credit memo, means return. In case there is a sales return from the customer, do they have pre-numbered credit memos? So which we record the sales return. So in this case, we are trying to check the validity of the documentation. So remember, here we mention about the controls activities, the control activities related to the sales and revenue cycle, and we have pre-numbered documents, one of it. So what we are trying to check all about the questions, we try to check adequacy or segregation of duties, proper authorization, adequate documents and records, pre-numbered documents, monthly statement, internal verification, or we call it independent verification and review. So here we are in number 10. We are trying to check the pre-numbered documents. We are trying to see if they have if they have this document, existing document. Okay, number 11.
Unused sales invoice safeguarded and checked periodically.
Okay, so this one also is to see whether they have check the invoice. If we use pre-numbered invoice, so we expect that checking the unused invoice. So we check whether they keep it in a proper way, and also they are not using it, because sometimes they say if the staff want to steal some money, then they will say this invoice has been lost. So in that case, we need to report this, ensure that this number of invoice is not recorded in the transaction. Okay, so it's about reviewing and deductive of fraud. Okay, number 12.
Our sales invoice taken are arithmetically accuracy as to price, allowances, extension, and totals.
So in number 12, we are trying to check the accuracy, whether the numbers in terms of the total of the invoices is correct, and in terms of the total of items there. So we are checking the accuracy. Okay, so this one is trying to check whether they perform the accurate recording in the list of the invoices. Number 13.
All merchandise returns supported by pre-numbered documentation forms.
Yeah, this one is about the sales returns. So normally we have the credit memo documents, and as well as the form, the pre-numbered form for receiving these goods and record it again to the inventory system. Number 14.
Are all merchandise returns approved by a responsible officer?
So now we try to check the existing of approval process for sales return. Okay, if they have, okay, then if not, then we consider it as the deficient or negative internal control in this point. Okay, number 15.
Is there an overall check for reasonable of period sales data, example statistical and ratio analysis?
So in number 15, we check whether the company try to have analytical procedures or ratios to check the sales data in terms of the sales turnover, the inventory turnover, account receivable turnover, So in terms of time and also in terms of percentage. So that if they have it, then we consider this company is trying to control their having good intention to control the also the account receivable collection and so on. If not, then we consider this company is loose in terms of account receivable collection. 16.
Is there any periodic reporting of sales data to general ledger accounting independence of accounts receivable accounting?
So 16, we are trying to check the existing of reporting, monthly reporting, periodic reporting about the sales data and in terms of the balances of the account receivable, the cash collected, and also sometimes some report about the due amount, due balance to each customer monthly. Normally it's monthly, and in some countries they will have what we call weekly statement. Okay, number 17.
Does the accounting contain a chart of account and instruction appropriate for classifying sale?
Okay, so question number 17 is trying to check the recording now. We are trying to see whether they have internal control related to the recording transaction in the level of recording the transaction. So if the company have manual accounting manual, mean they have guideline for the general accountant, contain the chart of accounts, means they can refer to this manual to ensure the classifications of transaction. So if they have it, then for sure the misclassification of transaction will less happen. Okay, number 18.
Sales journal verify for correctness of entries made.
So in this question, we are trying to check the accuracy of entry of the recording, whether there is a process for verifying the sales journal in terms of the accuracy of the entries. Or sometime, if you remember, if you notice, sometime when you key in some amount, let's say, or trying to key in something in the internet, sometime you will have the warning notice or message saying that wrong entry. Sometime if you are, that is what we call the verification of correctness through the software. But if it is manual, then we expect that someone to review the entrance periodically. 19, sorry, last one.
Are summary totals of general entries checked monthly and approved before posting?
Okay, so now we have the two functions we are trying to check here. We see whether there is a review of the recording before posting, and there is approval process before the posting. Okay, so the 19 questions is an example. It's not fixed, but most probably we will have most of these questions. And those questions are mainly trying to check the behavior of the internal control of the company related to either related to the documents, related to the functions, the internal control functions, credit limit, approval, the documents appropriateness in terms of the documents pre-numbered or the documents, what information included in the documents. The approval process also, we try to check the approval and authorization process, the segregation process, and then the review and internal check. Okay, that's mainly about the normally what questions we include in the questionnaire to test the internal control related to the sales revenue and cash received. Okay, so let's say now the management assertions related to the revenue cycle and management assertions, and we also will talk about control procedures should be in place and what auditor should check. Okay, so now it will be more matching. So in accuracy or in occurrence, the management record the sales are to every transaction has been recorded. Okay, and sales transaction are properly authorized, approving credit, shipment of goods, and billing of customers. So this is what the management assurance in the right side about the occurrence. What the auditor will do, auditor will check whether each sales transaction is supported by proper documents, customer order, sales order, shipment document. Okay. Number two, approval should be obtained from the management, which we mean by approval of credit or approval of sending the goods to the customer. And goods ready for shipment should be checked against sales order and against sales order and also the other documents if the invoice has been sent simultaneously. There should be an approved price list and policies on credit terms and discounts. So whether they have those policies and procedures in terms of price list, because we don't that if the company, let's say, don't have the pricing list for with the sales department, then they will give discounts. Sometimes they will quote high price and sometimes they will quote low price, and within this they can play around with the amount, they can do fraudulent. Okay, so that is about the occurrence. Let's say what the completeness, accuracy, and cutoff and classification. For completeness, management say all sales transactions are recorded, and they said also in accuracy, recorded sales are for goods correctly and shipped and billed, so it's recorded correctly, accuracy. And then the cutoff and classification, sales are recorded in proper accounts and accounting period, in the right accounting period. Okay, so what is the auditor procedures? Auditor will check whether the customer order, sales order, shipment documents are pre-numbered in sequence and regularly checked by internal auditor. If they have that, then okay. And verify goods shipped with the sales order. Check with the approved price list when they're preparing the invoice, or programmed if they have software. And then year-end sales cut-off test or sales journal and journal ledger should be reviewed and tested. Okay, so this is the procedures to ensure the management assurance about those transactions. Okay, let's say now the summarize. Let's say the direction of test of sales. So what is the we have either from left or from the right side. So normally we have this customer order, then shipment of documents, duplicate sales invoice, then we will start recording in the sales journal in the second row, and then do the general record in general journal, and then we will post the same amount or the same balance to the account receivable master file. So we have two sides of test direction. One is checking the start from existence, we check the existence. And the second one is completeness. We start from completeness. We start to check the completeness. So to simplify, let's see from here, then we will understand better the what we call whether we check the existence or we check the completeness. Okay, now let's say we will understand that in the substantive test of transaction, of sales transaction. So we have what we call voting, we have tracing function. And voting and tracing, it's functions that what we discussed just now about the direction, it will explain, it will be clear here. So voting is to start from the documents, so you are checking the checking from the document whether it's existed in the record. So select samples, number one, or the substantive test of sales transaction in the audit program. Number one, we need to select samples of individual entries in the sales journal and watch to source document. We need to watch to source document. So meaning that we get the list of record in the, let's say, sales journal, and then we try to watch to the source document, which is the invoices. But the tracing is the opposite. We get the source document and we check the we check whether it is in the record. So if we go watching, it helps to check the completeness, whereby tracing is checking the existing. We will verify this in a short while. So select samples for shipment documents. So we watch to sales invoice, B to trace to entries in journal. So you can see watching is to watch from record to the invoice, to the document. Trace is to trace entries, trace documents, invoice, let's say, to the entries. So we are checking the completeness for tracing. Watching, we are checking the existing. And also C is tracing posting to subsidiary receivable ledger. So we are checking the flow, whether all of the transactions in the posting to subsidiary is recorded in the subsidiary receivable ledger. Number 3 is to perform year-end sales cutoff test. We are here trying to check the classification and cutoff. We are trying to check whether all of this transaction is properly classified and properly recorded in the right accounting period. Number 4, verify arithmetic accuracy. We are trying to check the accuracy of the sales invoice and sales journal. Number 5 is to scan the sales journal for large or unusual items. So here, number 5, it is we are doing the scanning and doing watching and tracing for the unusual and large transaction. Reason, because we will not include big transaction within our samples, because it will carry big amount. So we will separately and do it in a separate manner. Number 6 is perform analytical review and procedures. So we are trying to review, run some ratios to see, to have some indicators about the transaction behavior. So here, let's say, let's have this example to illustrate more about watching. As we said, we are trying to the first objectives or the first assurance is to trying to ensure the objective, the occurrence or the existing of the transaction. So we take the watching is from selected transaction in sales journal to we try to watch it to the source document. So from sales journal, we will take selected the transaction. We try to check the invoice, the sales order, the shipment documents related to this transaction. So watching is trying to check the existing of the transaction based how they record these transactions in the sales journal. So we need to check, they have the supporting document in terms of sales invoice, sales order, and shipment of documents. So in this case, we call it watching techniques. Okay, so let's say the tracing techniques. Tracing techniques is examining the documents and follow them through the records. So we see here the shipment documents, sales invoice, sales journal, and receivable ledger. So we check, we take, let's say the shipment, we take from the archive some shipment documents, and then we try to trace to see whether there is a sales invoice, and we try to match it with the amount in the sales invoice with the sales journal, and we check the posting amount to the receivable ledger if it is accurate. In this case, when we do it from down to up, from the documents to the record, we call it tracing. If we do watching, then we call it if we do from up to down, from the record to the documents, then we call it watching. And watching, it helps to achieve the objective of existing or occurrence. For the tracing, it helps to achieve the objective of completeness. Okay? Hope it's clear. So now then we have accuracy. Accuracy, we do watching, checking for the consistency of the depreciation, quantities, price, amount, terms, and dates. And also we do computation and recalculation of the amount, adding columns, cross-adding totals, and so on. So it's kind of arithmetical calculation. We try to recalculate, we check the accuracy of the record based on the invoice and based on the list. Then classification. Classification, we need to check the manual accounting manuals, whether they have chart of accounts. We check the classifications of the account, and then we review the sales journal for proper account codes, whether they have accurate record of transaction based on the classification. Cut-off, it's about the timing of record. So sales cut-off test is comparing the record sales in sales journal with the sales invoice and shipment documents. We need to understand the shipment terms. We have two types of shipment terms, FOB shipping and FOB destination. If FOB shipping, then the sales can be the sales revenue can be recognized at the time of shipment. But if it is FOB destination, then we need to wait until the sales until it's received by the customers. Then we can the sales can be recognized upon arrival to the customer. Okay, so this is also it is the auditor's concern, external auditor's concern, to see the documents, the bills and leading documents or shipment documents, which will illustrate and clearly stated whether it's FOB shipment or FOB destination. So in that case, the auditor, if it is FOB destination, then he will see whether at the time of recognizing the transactions and the time they recorded. Okay. So after we finish that, we will do substantive test of account receivable. Okay. Just now what we do the substantive test of transaction itself when the transaction is happened. But let's say, what is the substantive test of of account receivable. So before we go on this, we need to understand that the account receivable account is considered highly risk. It is by nature is inherently risk. The reason because when you sell on credit, there is possibility you will not receive the cash back. You will, the payment either late or you will not receive it. That's why we it is this account is risky to the customers, one thing, and it is also it allow the customers or the client company to play around in terms of overestimate their assets by adding recording some sales in account receivable without having the cash, because they said, okay, you say the client customer number one owe me 5,000, customer number two owe me 10,000. So I have the value of wealth of assets of let's say 1 million. But in reality, this is not in your hand. So auditor facing the problem of verifying the existing of this account receivable, current assets, and number two is the problem of determining the value. We determine whether this value is accurate or not. Is it the value is right or not? Because sometimes the value may diminish or go down when we write off uncollectible account receivable or allowance. Okay, so what is the audit program of substantive test of account receivable? We have the 7 procedures or 7 steps functions we should do. So number one is conforming account receivable. We need to conform the accuracy of the account receivable. How to do that? We should send a letter of confirmation, request confirmation letter from some customers of the client, and we will discuss this in a next slide about the positive and negative confirmation letter. So number two is to obtain an age trial balance of account receivable. A, to verify the arithmetic accuracy of subsidiaries ledger account and agree total to general ledger control. Number two, or B, is to examine the aging of account receivable balance. Number C is to scan the trial balance of material credit balance. I think it's clear, but B, aging is to check how old is this account receivable, because sometimes if the account receivable aged, let's say 1 year, it means this one it should be included in the it should be write off, or more than 1 year should be write off from the current assets. So we need to check examine the aging of the account receivable balance, and we see whether which one should be existed and which one should be write off from the balance of account receivable. And based on usually the period of validity of the account receivable is based on the industry benchmark. Okay, and other items, sometimes it's because it's the aging of the account receivable for one customer is it is not easy to figure out unless we have the aging list or aging trial balance to based on the age, based on the amount, so we are able to analyze the aging account receivable balance. Number three is perform sales cutoff test. As I said, we try here to ensure that it's recorded in the right time and received in the right time. So sometimes companies they try to do what? To record the account receivable in this year, even the transaction or the sales is belong to the following or the subsequent year. So sometimes the customer place an order, but it's kind of monthly order. So in December, maybe they would record the account receivable for January 2021 for this year, just to overestimate the account receivable and the current assets as well as the value of the company. Number 4 is examining subsequent collection. If we have collection in the in year, let's say, because when we audit until March. So if there is collection, high collection in the January, so we need to ensure that we need to examine this subsequent collection, because some collection is belong to the previous year, to the 2019. Okay. Number 5, scan individual account receivable from unusual transaction. So if there is unusual transaction, we need to scan it, because sometimes, let's say, we write off some account receivable for last year, and then this year the customer show up and come and pay us back. So that is unusual transaction. We need to see how the company recorded and how they deal with it in terms of accuracy and also classification. So number 6, review minutes of board of directors meeting and read contract and agreements for any account pledged. So what we do here, we try to check the minutes if there is any thing related to the account receivable in term and also the contracts with the customers. Number 7, perform analytical procedures related to the account receivable in terms of the timing, the day or the turnover of the payment by the customers, and also in terms of the amount ratio or the percentage, sorry. So to check the existing, according to ISA 505, we have external confirmation techniques, as I mentioned in number 1 in the audit program for the account receivable. We have positive confirmation, we have negative confirmation, and we need to understand that positive confirmation, the debtors of the customer of the client must respond, either agree or not. So they need to agree, they need to respond whether they agree about the amount we stated in the confirmation letter sent to them, or for the negative confirmation, the debtor only respond when they disagree. Okay. So this is comparing between the two, positive confirmation and negative confirmation. For maybe I have 2 students. Can I have two students, one student to read positive confirmation, one to read negative confirmation, please? Hello.
Positive.
Hello.
Yeah.
Yes, please. One to read positive and one negative. So the first point in positive, please start.
Positive confirmation. The reply indicates an agreement or disagreement with information provided.
So in the positive confirmation, we will receive reply, either agree or disagree. How about negative?
A reply indicate disagreement with the information provided.
So only if they are disagree with the amount, then they will reply. If they agree, so they will just ignore. Number 2.
Late confirmation might elicit no response due to extra effort required.
Okay. Negative.
No response might be due to other reasons.
Okay, so for the positive confirmation, the customers maybe will not reply due to then they feel it is required extra effort, because you need to write the agreement of this amount or not. But for the negative, you maybe due to the other reasons, because if they disagree with the amount, they will for sure they will reply, but sometimes maybe they feel busy or something, so they will not reply. Positive confirmation. Next,
more reliable.
And negative is less reliable. Okay, so yes, more reliable because you are stating the amount and ask them to agree or disagree, but negative only if they disagree. Okay, next. Next is high risk of risk of material misstatement. And negative is low risk of material misstatement. And next is large of balances and negative confirmation small balances. So we use the negative for small balances. For big amount of balance of account receivable, we send them positive confirmation. Okay, so this is an example for positive account receivable confirmation request. So I will request one student to read this, please. Hassan Engineering Berhad. Hello.
Yeah.
Please.
Okay, Hassan Engineering Berhad. Which one, doctor?
Just read their shares. Their shares according.
Okay, sir. Okay, dear sir. According our record, the balance outstanding on your account as at 31 June 2006 was 23,456.78. Is the agrees with your records on the date. Please sign the confirmation from the form in the space provided below and return in the enclosed business reply envelope direct to our auditors. So to Nabil and Cooperation, if your balance does not agree with your records, please inform your auditor out of the amount shown by your records, giving full details of differences on the reverse side of this form. Yours faithfully, Hassan Engineering Berhad.
Okay, so what we understand from confirmation, positive confirmation letter, that the one who sent the confirmation is the client himself, and the one who received the confirmation is the auditor. Okay, so this is the thing that I want you to understand it, because sometimes students misunderstand this point, because the one who sent is the client, but based on the request of the auditor give the list, ask them please send positive confirmation later to those customers, to this list of your customers, and negative confirmation to those customers. So, and if you agree, if this amount is agree with your record, then please just see it's agree and sign. If not, then please state what is in your record. Stated, write the difference. Okay. So this is the confirmation, which is more. It requests the customer or the debtor to write something. But let's say the negative request. Okay, so maybe I ask another student, please read from their sir in connection. Hello.
Yes, sir.
Yeah.
In connection with audit of the financial statement of insert name of client as of December 31, 2000X, and for the year then ended, please examine and include statement carefully. If it does not agree with your record, please report any difference directly to our auditors.
Okay, so if it's not if disagree, then they will write the different. But if it's agree, then they will just ignore they will not reply and send back the letter back to the auditor. Okay, so this is the main difference between positive and negative confirmation. Please bear in mind, because questions they will come related to the type of confirmation. And remember, sometimes you will be asked what is the auditor procedures to, let's say, to overcome the account receivable issues. They will give you certain issues. So you need to mention something related to the confirmation. Okay. Completeness. We need to do, to understand here what the auditor trying to check. Auditor trying to answer this question: does the balances of account receivable contain all transaction for the period? So we need to reconcile subsidiaries ledger and compare with the general ledger, and we need to do perform sales cut-off test. We need also to do analytical procedures, turnover ratios, compare with the period budget and industry average, and trace shipment documents to sales invoice. Valuation and collection. Remember, here we are in the valuation and collection. Valuation and allocation. It is in the level of substantive test of details of balance. Okay, so the question is: are receivable valued at the net realizable value? So how to answer this question is: first is to examine subsequent collection of the year-end receivable, cash receipt. Two is to evaluate client credit history, examine the aging schedule, review supporting documents, and lastly, discuss with credit manager. Okay, then presentation and disclosure. Are sales and receivable being disclosed in the appropriate disclosure? So what the procedure to do is evaluate the income statement and balance sheet for the proper classification, scan the aid trial balance for large and unusual items. Scanning may amount to reclassification. Okay, so this is the end of the transactions that we should do, or the procedures of the auditor, and we link it into the 3 steps. So overall, we need to understand that for each accounting cycles, we should do these steps. Number 1, we need to first understand the functions functions and activities in that accounting cycles. So in revenue, sales revenue, and cash receipt, the functions we have is first is the customer order, and then sales order, then the credit limit check, or credit guaranteeing credit limit, and then we have the shipment, and we have the billing and recording, and then we have the cash receipt collection, and then we have the sales return and allowance, then we have write-off of the transaction. So this is the functions. Okay. So what is the documents involved? What is the department involved? This one also you need to know. What is the flow of transaction? So you, as an auditor, need to understand it from A to Z, and then we need to start doing our test. And we have first, before we do the test, we need to design the what we call design the test of transaction and details of balance and the internal control test. So how to test that? How to design this? We need to first understand the client business. We need to assess the planned control risk, and then we need to do the test of control, the extent of test of control, and then we design, or what we call we do the program, audit program, or planned audit procedures. What audit procedures will do? So we need to include in our design 4 items. One is what is the type of audit procedures. Number 2 is the sample size or the sample selection, item to select, and number 4 is the timing, when to perform this test. And then we need to classify our test into 3 or 4 actually, but 3 is the main. 1 is test of control. Number 2 is substantive test of event and transaction. Number 3 is substantive test of details of balance. And test of control and substantive test of transaction are normally done in the same time. And then substantive test of details of balance done in the end of the accounting period. Okay, so the last topic is about auditing the sales and cash receipt system in IT environment. So this one I will is kind of just to show how the flow of the system, the flow of transaction and activities will be computerized, and we have less documents, and we will have more internal control procedures through the software and so on. What I would like to mention before we end up today, that all of these procedures that the auditor will do, it should be in line with the audit objectives and management assertions related to that transaction or the accounting cycle. Okay, so I believe that's all for this chapter. So any question, please? Do you have a question?